Well, I think it's a couple of factors. The first is we have a below consensus growth forecast for the U.S. economy next year. We have U.S. growth slowing all the way down to a 1% annualized growth rate in the third quarter. And so we think that one, will reduce overall optimism towards U.S. assets, but specifically result in a pretty large deceleration in earnings growth for the S&P 500 from the current level of a 20-something% year over year for S&P earnings to just maybe 4% year over year next year. So a slower economic backdrop, weaker earnings growth, you couple that with continued tightening in the first half of next year from the Fed, and I think it's all a cocktail for a much more difficult outlook for U.S. equities relative to the rest of the world.
Yeah, your note is titled The Turning Point. So are those things their turning point? I mean, if things have been great for about, I don't know, about 8 years now, is this it?
Well, I think we are at an important shift, an important turning point for a number of key market relationships, right? In the backdrop for 2019, I think you still have the decelerating growth, the rising inflation, the tightening central bank policy that was with us in 2018, that continues. But I think for the relative relationships in the market, specifically U.S. growth versus the rest of the world, EM assets versus the rest of the world, for U.S. versus European bond yields, for the dollar, I think you have a number of important shifts that often all hinge on this relationship between U.S. growth and what's going on elsewhere. And again, 2018, an amazing year for the outperformance of U.S. assets. We just think, given their relative valuation, given the relative economic trends of the U.S. versus the rest of the world, that just is not going to be able to continue next year.
Yeah, and you say here, we think the bear market is mostly complete for EM, emerging markets. Emerging markets like the world, Andrew, a big place. Are there certain parts of the emerging markets that you find the most interesting right now at Morgan Stanley?
Well, we think the outlook in India is relatively attractive, given what's been happening with oil prices recently. We actually think the outlook in China next year could be somewhat better than low expectations currently say. We see odds that we'll see further fiscal stimulus there that will help stabilize the economy and stabilize growth. Our economists are reasonably constructive on Brazil and the currency outlook there. And then we're somewhat more cautious on Mexico at the other end of the spectrum, with more concerns or a more negative view on the currency there relative to, say, Brazil.
But you didn't just go from underweight to neutral. You went from underweight to overweight, the double upgrade. You jumped the floor. I mean, what caused that level of change?
Well, I think a couple of elements drove that level of change. I think the first is you have had an enormous repricing of EM assets. And again, the price matters. You've had a very significant derating of EM equities. You've had a very significant, even on the fixed income side, widening of credit spreads. So look, EM still has challenges. It's still going to have fundamental challenges next year, but the price is a lot better. We also think that the dollar backdrop is a lot different and a lot more supportive next year, as we think that slowing U.S. growth causes the Fed to pause hiking rates in the middle of the year, and that will support a weaker dollar throughout all of 2019.
What does that mean, though? If we believe your weaker dollar thesis, what does it mean for U.S. equities then?
Well, so look, the weaker U.S. dollar is, in aggregate, probably going to be a helpful thing for U.S. stocks. But it's the U.S. markets also kind of have to confront a number of negatives, right? You're no longer going to have the tailwinds from fiscal stimulus and from tax cuts that you had this year. The comps are just going to be a lot more difficult next year, as you no longer have that incremental bump from tax cuts. You're going to be facing a slower economic backdrop. I think you're going to start to see as well more pressure on margins as the effects of tariffs that are already in the supply chain start to bite. So, Brian, you're absolutely right. The dollar weakness next year will help the U.S. We just think that there are a number of other factors that are going to act as headwinds and make it a relative underperforming market.